It's funny, people talk about how much money they've invested and saved for retirement, but once we start looking at the taxes, all of a sudden you've got Uncle Sam as a partner, silent partner, but has a strong end result as when you start taking the distributions out of your investment accounts. When we look at the various ways of taxation, obviously, if we go Roth, it's tax-free. That's the perfect place where we want to get to, obviously. That way we don't have the RMD distribution issues. When you start taking dollars out of your investment accounts, then you have to start paying Uncle Sam. The problem is we don't know what the tax rate's going to be until we get there. So it's kind of like blindly saying that you will not pay the tax now and we'll wait 30 years and figure out what that tax rate is. The problem we see with the RMDs mainly are that we don't know what tax bracket are going to be once you get into retirement. But the other problem is if we have a married couple, one of the spouses dies, then all of a sudden we could be looking at going into a single tax bracket, and now we're bracket bumping because those RMDs are still going to be coming out. So all of a sudden now we're paying higher taxes. And then that spouse dies, and all of a sudden we've got kids having to go into a 10-year plan. So it's better to try to get to the Roth side. The beautiful thing about doing Roth conversions is it's not limited. So it's basically what we're looking at is your tax brackets. And let's say you're in the 22% tax bracket. We can go and max out that 22%, start getting those taxes whittled down, and we have some strategies that we can actually use other people's money to help offset these taxes. Tax efficient, obviously, we're going to be able to extend the time that you'll have those dollars in play. A lot of what we look at is when we look at your total investment picture, we want to be able to say how much dollars are needed for income, and we put them more on the protected side, and then the dollars for growth we keep into the market for cost of living adjustments, etc. With the new age limits of 73 or 75, depending on what year you were born, if we can do the Roth conversions prior to you hitting those ages, it allows us then to maybe get into a lower bracket at some point during that retirement. The main thing we focus on, though, is not having the dollars coming out going to a higher tax bracket. Example of that, we had a gentleman, he was just fixing to turn 73, had $1.5 million in. We were able to bonus over $200,000, and prior to him having to do those required, we were able to get some of that reduced for him. So the whole idea is that a second opinion never hurts. What we find is there's a lot of people in our industry that they do things certain ways, and sometimes it's just nice to be able to say, hey, if we did this instead of kind of going that way, then all of a sudden we've got a whole plan put together that can really save you dollars for future investments. Feel free to give us a call. Let's set an appointment. Let's do that initial review and see if we can save some tax dollars for you and put you in a better place for a retirement planning.